How to invest for beginners, 4 easy tips. Welcome back to Win Now, the place where we turn financial dreams into reality. Today we're diving deep into the mind of one of the greatest investors of all time, Warren Buffett. Now you might be thinking, what can I possibly learn from a billionaire investor? A lot, actually. You see, Buffett's success isn't about some secret formula or insider trading. It's about sticking to simple, timeless principles that anyone can apply. In this video, I'm breaking down 4 of Warren Buffett's most powerful investing rules, specifically designed for beginners. These are the exact strategies that can help you build long-term wealth and achieve your financial goals, just like the Oracle of Omaha himself. So buckle up, grab your notebooks, and let's get started. Warren Buffett is famous for saying, "Never invest in a business you cannot understand." This simple yet profound advice has guided countless investors towards making more informed and confident decisions. Buffett's philosophy is rooted in the idea that understanding a business inside and out is crucial for making sound investment choices. Think about it. Does it make sense to put your hard-earned money into something you don't even get? Investing in something you don't understand is like navigating a ship without a map. You wouldn't set sail without knowing your destination, or the waters you'll be traversing, so why would you invest without understanding the business? Buffett believes in investing in companies and industries he understands inside and out. This means he spends a significant amount of time researching and analyzing potential investments. He dives deep into the details, ensuring he grasps every aspect of the business before committing his money. He reads annual reports like they're novels, digs deep into financial statements, and analyzes a company's competitive advantage. This thorough approach allows him to make well-informed decisions and avoid potential pitfalls that come with investing in unfamiliar territory. He's not chasing after the latest trends or get-rich-quick schemes. Instead, Buffett focuses on the long-term potential of a business. He understands that true wealth is built over time, not overnight. This patience and discipline are key components of his investment strategy. He's looking for solid businesses with strong fundamentals that he can hold for the long haul. These are companies with a proven track record, reliable earnings, and a sustainable competitive advantage. By focusing on these attributes, Buffett ensures that his investments are built on a solid foundation. For example, Buffett has famously invested in companies like Coca-Cola, Apple, and American Express brands we all know and use regularly. These companies have strong brand recognition, loyal customer bases, and consistent financial performance, making them ideal candidates for long-term investment. He understands their business models, their target markets, and their long-term potential. This deep understanding allows him to confidently invest in these companies, knowing that they have the potential to grow and thrive over time. Now, this doesn't mean you need to become a financial expert overnight, but it does mean taking the time to research and understand the companies you're considering investing in. Start by learning the basics of financial statements, industry trends, and the competitive landscape. But it does mean taking the time to research and understand the companies you're considering investing in. Look into their financial health, their business model, and their market position. The more you know, the better equipped you'll be to make informed decisions. Don't just blindly follow the hype or listen to what others are saying. Social media and stock tips from friends can often lead you astray. Instead, focus on your own research and analysis. Trust your own judgment and make decisions based on your understanding of the business. Do your own due diligence. This means thoroughly investigating a company's financials, management team, and market position. Look for red flags and potential risks, and weigh them against the potential rewards. Learn about the company's products or services, their management team, and their overall financial health. Understanding these elements will give you a clearer picture of the company's potential for success and help you make more informed investment decisions. Remember, investing is like partnering with a business. You want to be in it for the long run, and that starts with understanding what you're getting yourself into. By treating your investments as partnerships, you'll be more likely to make thoughtful, informed decisions. You want to be in it for the long run, and that starts with understanding what you're getting yourself into. Take the time to learn, research, and analyze. Your future self will thank you for the effort you put in today. This rule might seem obvious, but it's easier said than done. Many investors, both new and experienced, often find themselves caught up in the excitement of potential gains and overlook the importance of safeguarding their capital. Warren Buffett's #1 rule is, rule number 1, never lose money. This principle is not just a catchy phrase, it's a fundamental mindset that has guided his investment decisions for decades. Rule number 2, never forget rule number 1. This reiteration emphasizes the critical nature of the first rule. It's a reminder that the primary goal of investing is to preserve your capital. He understands that every dollar lost is a dollar you could have invested and grown over time. The power of compounding means that even small losses can have significant long-term impacts on your portfolio. That's why he's such a strong advocate for risk management. By carefully evaluating the risks associated with each investment, you can make more informed decisions and avoid unnecessary losses. He's not afraid to walk away from a deal if it doesn't feel right, even if everyone else is jumping in. This discipline is crucial in avoiding the herd mentality that often leads to poor investment choices. He'd rather miss out on a potential gain than risk losing his capital. This cautious approach ensures that he only invests in opportunities that align with his risk tolerance and investment strategy. Now, this doesn't mean you should be paralyzed by fear and avoid investing altogether. Instead, it means approaching each investment with a clear understanding of the risks involved and a plan to mitigate them. It means being smart and calculated with your investments. Diversification is one strategy that can help spread risk across different assets, reducing the impact of any single loss. Before hitting that buy button, ask yourself, what are the potential downsides? Consider the worst-case scenarios and how they would affect your overall financial situation. How much am I willing to lose? Understanding your risk tolerance is key to making investment decisions that you can stick with, even during market volatility. What's my exit strategy if things go south? Having a clear plan for when to sell can help you avoid emotional decisions and lock in profits or cut losses at the right time. Remember, investing always involves some level of risk. No investment is completely risk-free, but by being aware of the risks, you can make more informed choices. But by understanding and managing that risk, you can protect your capital and set yourself up for long-term success. This approach not only helps in preserving your wealth, but also in growing it steadily over time. In a world of instant gratification, Warren Buffett's patience is a breath of fresh air. In today's fast-paced society, where everything is expected to happen at the click of a button, Buffett's approach stands out as a testament to the power of patience. He has built his fortune not by chasing quick wins, but by understanding the value of time and the benefits of a long-term perspective. He's a firm believer in the power of long-term investing and letting your money compound over time. This means that instead of trying to time the market or make a quick profit, he focuses on the bigger picture. By allowing investments to grow and compound, he harnesses the exponential growth that can occur over decades. This strategy requires a deep understanding of the market and a commitment to staying the course, even when the market is volatile. He doesn't get swayed by short-term market fluctuations or panic sell when things get rough. Instead, he remains calm and collected, understanding that market downturns are a natural part of the investment cycle. This level-headed approach allows him to take advantage of opportunities that others might miss due to fear or impatience. By staying the course, he often finds himself in a stronger position when the market recovers. He knows that time is his greatest ally, and he's willing to wait for the right opportunities. This patience is not just about waiting, but about being strategic and thoughtful in his decisions. He carefully analyzes potential investments, looking for those that offer long-term value rather than short-term gains. This disciplined approach has been a key factor in his success. One of his most famous quotes is, "The stock market is a device for transferring money from the impatient to the patient." And he's absolutely right. This quote encapsulates his investment philosophy and serves as a reminder that those who are patient and disciplined are often rewarded in the long run. It's a principle that can be applied not just to investing, but to many areas of life. The longer you stay invested, the more time your money has to grow exponentially through the magic of compounding. Compounding is the process where the returns on an investment generate their own returns, leading to exponential growth over time. This is why starting early and staying invested is so crucial. The earlier you start, the more time your investments have to compound and grow. It's like a snowball effect. The earlier you start and the longer you let it roll, the bigger it gets. This analogy perfectly illustrates the power of compounding. Just as a small snowball can grow into a massive one as it rolls down a hill, a small investment can grow into a substantial sum over time if left to compound. This is why it's important to start investing as early as possible and to remain patient. Now, being patient doesn't mean being passive. It means being actively engaged in your investment strategy and making informed decisions. It involves regularly reviewing your portfolio, staying informed about market trends, and being ready to make adjustments when necessary. Patience in investing is about having a long-term vision and the discipline to stick to it, even when faced with short-term challenges. It means having a long-term vision for your investments and sticking to your plan, even when things get bumpy. Market fluctuations are inevitable, but a well-thought-out investment plan can help you navigate these ups and downs. By focusing on your long-term goals and not getting distracted by short-term noise, you can stay on track and achieve your financial objectives. Remember, Rome wasn't built in a day, and neither is a successful investment portfolio. Building a strong portfolio takes time, effort, and patience. It's a gradual process that involves careful planning, consistent investing, and the ability to stay the course even when faced with challenges. Just as Rome became a great empire through steady growth and development, your investment portfolio can grow into a substantial asset over time. Stay focused on your goals, tune out the noise, and let time work its magic. By maintaining a clear vision of your financial objectives and not getting distracted by short-term market movements, you can achieve long-term success. Patience, discipline, and a long-term perspective are the keys to building a successful investment portfolio. Trust in the process, stay committed to your plan, and watch your investments grow over time. You've probably heard the saying, "Don't put all your eggs in one basket." Well, Warren Buffett takes this to heart when it comes to investing. He understands the importance of diversification. Diversification simply means spreading your investments across different asset classes, industries, and geographies. This helps to reduce your overall risk. If one investment performs poorly, you have others to cushion the blow. It's like having a safety net for your portfolio. However, Buffett also cautions against over-diversification. He believes in owning a concentrated portfolio of companies you truly believe in. In his words, diversification is a protection against ignorance. It makes very little sense for someone who knows what they're doing. So the key is to find the right balance. Don't put all your money into one stock or sector, but don't spread yourself so thin that you dilute your potential returns. A well-diversified portfolio should reflect your risk tolerance, investment goals, and overall financial situation. There you have it, future billionaires. 4 simple yet powerful investing rules from the Oracle of Omaha himself. Remember, investing doesn't have to be complicated. By following these timeless principles, you can set yourself on the path to financial freedom. And hey, if you're serious about building wealth and taking control of your financial future, I've put together a free guide that dives even deeper into these strategies. You'll find actionable tips, resources, and everything you need to start investing like Warren Buffett. Just click the link in the description below to download your copy today. Now get out there, start investing, and let's build those empires together.